Brad Williams, Frugal Finance, effect of below market financing on house prices. There are many situations where a home buyer may have an opportunity to purchase a home and obtain financing at a below market interest rate. One case, which we've already discussed, occurs when the seller of the house has a below market rate loan that can be assumed by the buyer. Below market financing might also be provided by the seller of the home with a purchase money mortgage. In this case, the seller provides some or all of the financing to the buyer at an interest rate lower than currently available in the current market. Indeed, this type of financing is quite common during periods of tight credit and high interest rates. It should be obvious to the reader that below market rate loans have value to the buyer. However, because the informed seller of the home also recognizes the value of such financing, we would expect the seller to increase the price of the house to reflect this value. That is, the price of the house will be higher when accompanied with below market financing than it would be with market rate financing. We now consider how a buyer would analyze whether to purchase a house with below market financing if the house price is higher than that of an otherwise comparable home does not have below market financing. To illustrate, suppose a home could be purchased for $105,000 subject to an assumable loan at 9% interest rate with a 15-year remaining term, a balance of $70,000 and payments of $799 per month. A comparable home without any special financing costs $100,000, and a loan for $70,000 could be obtained at a market rate of 11% with a 15-year term. Which alternative is best for the buyer? Note that we are assuming that the two loan amounts are the same. In analyzing this problem, we must consider whether it's desirable for the buyer to pay an additional $5,000 in cash for the home in order to receive lower payments on the below market loan. The calculations are as follows. Will the higher house price be reflected in the asking price? Let's see. Purchase price is $105,000. You're going to input this information. Assumed interest rate 9%, 2% lower than the market rate. Term 15 years, loan balance $70,000. Loan payment $710 is calculated. Comparable home asking price $100,000. Loan amount $70,000. Interest rate 11%. Term 15 years. Here's the down payment $30,000. So now we have a market rate loan of $30,000, a loan assumption of $35,000. The difference is $5,000. Here's the deal. We have this $100,000 deal, $30,000. We have a payment of $795.62. We have this loan assumption, $35,000. Payment $709.99. Rounded up to $710. The difference is $5,000. The monthly payment difference $85.63. Paying the extra $5,000 is equivalent of earning 19.41% versus the 11% market rate loan, or a net of 8.41% gain. What we did is we took the rate. C32, it's going to be that number of periods is C32, 15 times 12. We have this payment of D36, which is $85.63. We have a present value of $5,000. We're going to multiply this times 12 to come up with that rate. 19.41%. At what price should the property be if the loan is to be assumed and priced in parity with the market interest rate? It should be $107,534. Payment at higher value, verification check, $11.22, market interest rate 11%. We find that making the additional $5,000 down payment would result in earning the equivalent of 19.41% because of the lower loan payments. Alternatively, should the buyer decide not to pay the additional $5,000, he would have to find a return of 19.41% on the $5,000 in an investment comparable in risk. The 19.41% rate is higher than the 11% market rate. It appears desirable. Here's the second scenario. once you just work through this, it looks like scenario 2, balance is 50,000K. Borrower needs a second loan for 20K, 15 years at 14%. Here we have 795. We have a loan assumption 773. The difference is 2214. The gain is a negative 2.9. At what price should the property be if loan is to be assumed? Looks like 101,948. Play around with this. This is interesting. Make sure you understand what's going on here. You're paying $5,000 more, but in the end, the difference is 19.41% in your favor. Brad Williams, Frugal Finance. Thanks for watching.